thank you so much for taking time out of your busy day to give us some insights on what JP Morgan and your team thinks that we're in store for 2025.
Thank you so much. I think that was a great setup. 2024 was a pretty strong year for the economy and markets, and we do expect 2025 to be a pretty strong year for the economy and markets as well. A lot of the strength that underpinned our current macro environment in 2024 should continue into this year. But the big swing factor, of course, is around policy. And not just around the new incoming administration and fiscal government policy, but also around monetary policy. Because if you think about the meeting that the Federal Reserve had back in December, it seemed like around up until that point, there was consensus about what the Fed would do in 2025. And now there's a lot lower degree of consensus and conviction about the path of monetary policy going forward. And while you expect politics to be unpredictable, you don't expect monetary policy to be quite as unpredictable, certainly as it has been the last couple of years. So both of these things can potentially change some aspects of the outlook or cause a bit more volatility within the markets. But overall, again, we do see a lot of strength going into 2025. So we will share a few slides here today from our flagship publication, The Guide to the Markets. And I'm going to start on the first slide. If we move one forward, thinking about economic growth. So we measure economic growth in real GDP, gross domestic product, outside of the impacts of inflation. And we show it on this slide here on a quarterly basis, all of the different things that comprise that economic growth. So if you look at that box as well, we lay things out in terms of their overall contributions, and 68% of the economy is consumption. Consumers have continued to spend in those lighter blue bars, and while the composition underneath the surface has moved from lower and middle income consumers spending to more upper income individuals spending, the spending was on goods and services, pretty much everything underneath the sun, to more services and more judicious spending. These numbers are still aggregate. So it matters a little bit less about what's going on underneath the surface as long as things are broadly in good shape and there's no real pain points. And it matters more what's going on at the aggregate level. If you look at the green category there, that lime green category is the second biggest one in terms of contributors to our overall economy, and that is government spending. Last year, not only did we notch nearly a $2 trillion deficit, but also state and local governments were spending quite a bit. And then finally, the gray bars there look at business fixed investment. Think about the capital investment that businesses make. That was very strong. Businesses were spending on things like AI, also taking advantage of subsidies like the CHIPS Act and the IRA Act. And this is all pretty remarkable in the face of higher rates and higher financing costs, where things got a little bit more expensive and nonetheless businesses continued to spend. So when you have all of the major actors in the economy spending at a pretty healthy clip, consumers, government, businesses, that tends to be very supportive of growth. And in fact, in 8 out of the last 9 quarters, growth trended above average growth rates. Now, we do expect things to start moderating in the year ahead and get kind of back down to normal levels. But nonetheless, we have incredible strength coming off of the end of last year. Now, if we take a look at the next slide, if 68% of the economy comes from consumption, then broadly speaking, the worker is the consumer is the worker. If the labor market is in a good position, then that should also help growth because people are earning a living wage and they have jobs. So what we can look at on this slide here is some of those labor market dynamics. In gray, you can see the unemployment rate over time at about 4.1%. And if you look at that gray line across the slide here, it's remained pretty low. Now, it's not just that unemployment is low, it's also that it's been pretty stable. So for the last 3 years, unemployment has been at or around 4% at that unemployment rate. In addition, that blue line there looks at wage growth on a year-over-year basis. It has come down, but it has sort of plateaued at a reasonably high level. And if you, again, look back at that line over the course of history, it's pretty elevated relative to history, even though it has come down. And critically, wages have outpaced inflation for the last 20 consecutive months. That means in aggregate, people are earning faster than their cost of living is going up. So pretty stable and healthy labor market. Now, of course, growth is looking pretty good, labor market's looking pretty good. The bugbear of the economy persistently for the last couple of years has been inflation. So if we take a look at the next slide on inflation, what we've tried to do here is not just show line charts of where inflation has been and where it's going, but what's going on underneath the surface. So here we look at contributors to headline CPI inflation, which is essentially a broad measure of inflation throughout the economy. And what you can see in 2021 and 2022, that nice colorful rainbow mountain, is that inflation was coming from everywhere: commodities, goods, services, shelter. And yet, where we are today is much more narrow, concentrated sources of inflation. And in fact, it doesn't look all that different to parts of 2018 and 2019 in terms of what's the big driver. Shelter, a small but very potent category, which is auto insurance and broader services. Now, you can see here, we don't need to collapse these categories in order to bring ourselves closer to our 2% inflation target. We just need to chip away a little bit at each of them. And even areas like shelter and auto insurance have been showing some progress from a decline perspective. We have come a long way. We still have a bit of ways to go as inflation is getting a little bit stuck and a little bit stubborn where we are here, but we do think we can continue to make some progress on some of these categories. Now, if we fold in some of the dynamics of the incoming administration, one thing to be mindful of is that this is yesterday's inflation. And the Fed is dealing with this unenviable challenge of fighting yesterday's inflation, looking at today's data against the specter of potentially higher inflation in 2025. If we think about other sources like tariffs, for example, if you look at consumer spending, 17% of consumer spending is imported goods. So if you look at that orange category that has actually been deflationary more recently, that could start to pick up more if goods become more expensive, if input costs become more expensive as well. So it's something to watch. But again, inflation has been a little bit stubborn, a little bit sticky here, but after making a pretty tremendous amount of progress. The way I think about it is, for anybody who's kicking off the year with a weight loss goal, maybe you want to lose 15 pounds. It's those last 4 or 5 pounds that are the hardest to shake. And it's the same thing with inflation. So now if we take a look at the next slide, thinking about that unenviable task that the Fed is faced with, trying to balance all of these different factors, what they've done so far is they have kicked off an easing cycle and have started to cut rates. So this slide looks at the federal funds rate over time, that key benchmark policy rate, which they lowered starting in September by about a percentage point so far. Now, where do we go from here is the key question. And I think that there's really no straightforward, high conviction answer to that. What we do look at, though, is the green line that looks at market expectations of where we go from here relative to the blue line, which is the Fed's quarterly projections of where we go from here by various year ends. So, for example, by the end of 2025, the Fed expects to cut by another 0.5 percentage point or potentially 2 more rate cuts, whereas the market has really oscillated so far in the first 22 days of the year or so between or 2 potential rate cuts. So ultimately, what will the Fed do? Maybe they'll cut twice, maybe they'll cut once, maybe they won't cut at all. It will really depend on how the economic data comes in throughout the year. It's not expected that if they do cut, that first cut will be that won't be until this summer. So hard to make really clear conclusions here when there is so much fog around what the Fed will do. But I think there are 2 conclusions you can draw. One is that we're probably in a high for longer rate environment. Rates are going to stay up higher, which means if you are a fixed income investor and you buy bonds, you're probably going to have pretty good access to income. But 2, because there's a lot of uncertainty, we're probably going to continue to see rate volatility. And that means the diversification benefits we've come to know and love from fixed income are a little bit less reliable than they have been in the past. So think about over the next year, your fixed income allocation providing that income, but perhaps some of those diversification and protection benefits will not be as great as they could be down the line if you face some economic troubles at some point in the future. It's just important to know why you own things, when you own them for, what environments they'll do well in. Now, if we take a look at the next slide, you can see that dynamic on this slide here. This slide looks at 10-year government bond yields in blue, and then if you subtract out inflation, that's that line in gray. And again, we've had a long stretch of time where rates have been falling. Not only have they been rising over the last couple of years, but they've been rising pretty rapidly, and even in particular over the last 6 or so, even actually the last 4 or so months, they've come up by a percentage point. Again, a very unusual environment in which the Fed has cut a percentage point and rates have risen a percentage point. And this is just January 13th, a week ago, where the 10-year Treasury yield was at 4.79. Now it's closer to about 4.6. That is how sensitive these yields are to data. What I'd also point out is that yields are not just sensitive to growth or inflation data. They are also increasingly sensitive and had been for many, many decades in the past, been very sensitive to debt and deficits. Essentially, if you are a holder of a government bond and the U.S. federal finances are not in good shape, you might want to command a higher yield to own U.S. government debt, as opposed to if federal finances were in great shape and the budget was balanced. So that is a dynamic that we hadn't really seen that much over the last 10 or 15 years, but that is coming back into play and also putting a bit of a floor on bond yields as well. Again, big takeaways for bond investors: look for income in bonds, but understand that downside protection given rate volatility and the fact that rates have risen may be a little bit less reliable in the short term. Now, on the next slide, thinking about the equity market, the dominant theme over the last 2 years has been that the equity market has been driven by the Magnificent Seven stocks, those big mega cap tech companies. Now, you can see that very clearly on the left-hand side in green, where we look at the performance of the Magnificent Seven relative to everything else in the index in blue. Really has had a stellar 2 years. However, we do think that there could be a bit more of an inclusive rally in 2025, as you'd see on the top right-hand corner, where the earnings growth of the Magnificent Seven starts to decelerate to some degree, whereas the rest of the index starts to accelerate. Because what's going on underneath the surface is areas like industrials, energy, materials, utilities have all been effectively in an earnings recession, and they are set to emerge from that over the course of this year. So you'll start to see stronger performance from an earnings perspective of the rest of the index, while the Mag 7 will still do fabulously well at potentially 20% earnings growth, but nonetheless will moderate a little bit from here. That could lead to somewhat more of a balanced performance dynamic going forward. Now, that doesn't mean we don't want to own the Mag 7. Take a look at the bottom right chart. The profit margins are stellar, but we just want to be a little bit more diversified, because the biggest does not always mean the best. In fact, the best 10 stocks in the S&P 500 last year, of those best 10 stocks, only one of them was a Mag 7. Only 3 of them were tech stocks, and the other 7 were from industrials, utilities, and energy. So that careful stock selection can help from a return standpoint. So let's think about diversification and where to find it. If we move forward one slide, it's not just Mag 7 versus everything else, or value versus growth, or large versus mid and small cap. It's also about the US versus international. And I know international stocks have not performed particularly well in recent years, but I do think that while the US is a 5-lane highway, tons of avenues for opportunity, it is also very well trafficked. Whereas from an international perspective, think about international investing as taking one of the back roads. It can feel long and winding and circuitous, but there are often gems along the way. It is a narrower scope for opportunity, but you can find some differentiated sources of return. And you can find a lot of interesting cousins, I like to refer to them as, because you can find very similar businesses and companies abroad that you can find in the US, except they might trade at a lower valuation because they're not domiciled in the US. So if you look at the best 50 performing stocks last year in this chart on the left here, 36 of them, or 70% of them, were from international markets. It seems like the US is the only game in town, but we have seen a number of outperformers in other places, and that wasn't just a fluke last year. 33 companies on average are from outside the US when we look at the best 50 stocks in the world. If we take a look at the next slide, this clearly doesn't mean the US markets are without risk, and that is why we think about diversification, because we have valuations at high levels and concentration also at high levels. So if you look at the chart on the left, we look at the valuations of the top 10 stocks, which are about 40% more expensive than their long-term averages in green, and the rest of the stocks in the S&P 500, which are still in blue, about 15% more expensive than their long-term averages. The problem with high valuations is that when valuations are priced for perfection, they are often primed for correction. Anything can unseat them. They can be a little bit delicate. So we do want to be mindful of that. And the problem that we're facing in portfolios now is if you look at the top right, those top 10 stocks make up almost 40% of the index. During the tech bubble, they made up less than 30%. And that was considered a highly concentrated period of time. So what we want to be mindful of is that the swings in some of these big stocks can really be felt acutely in portfolios. It's great on the way up, it's not so great on the way down. Now, I do want to highlight that this is a risk for us, but not necessarily an immediate concern. And the difference here is like, look, things could fall apart and they could pose a challenge, but that's not our base case. Because if you look at that bottom right chart, these top stocks are still providing a lot of value to shareholders. They are growing and innovating, investing for the future. They account for 40% of research and development in the S&P 500 and 20% of CapEx. If you look at profitability and healthy balance sheets, they are a quarter of free cash flow and net operating income of the S&P 500. So they are still, again, providing value and quality for shareholders. We just want to be mindful of the valuations and the concentration there. If we move one slide forward, volatility is back, but it is important to recognize in what circumstances we are concerned about volatility and what circumstances we are somewhat less concerned. And basic rule of thumb for me is if the economy and corporate profits look strong, I don't worry as much about volatility. It is a normal part of investing. If things are looking much more fragile in the economy and within profitability, that's when I worry that volatility could lead to a more protracted correction. What you can see on this slide, though, is that the patient investor in times where things are pretty good can ride out volatility to often a pretty good end. So what you can see on this slide here is the S&P 500's calendar year return in gray, along with the maximum the market fell in red. We haven't experienced a lot of volatility over the last 2 years because on average we drop about 14%, and that was not the case in 2023 and 2024. But we started to experience a bit more volatility this year. But 75% of the time, those calendar year returns have ended up being positive. And what we do feel some solace in this year is that the economic and profit outlook is strong. Finally, we'll take a look at the next slide. I will end here. I've talked a lot about diversification, and here's why. What you can see on this chart here is a top to bottom ranking of different asset classes that might appear in a portfolio, and then a composite diversified portfolio in white. What you can see is that it's really hard to predict what will be the best performing asset class, but also often the best performer one year is the worst performer the following year. So being sensibly diversified across the board can help capture some of those returns on the upside, but also protect on the downside. And this is a year where there could be a lot of upside. Growth looks good, profits look good, the labor market looks good. At the same time, there are still risks. What's the Fed going to do? What is the new administration going to do? Will we see stickier inflation? Valuations are high, market is concentrated. So we want to achieve a nice sensible balance in that portfolio to help deliver a more stable and smoother ride from an investment return perspective.
On behalf of the entire team at ICG Next, I want to thank you and the entire team at JP Morgan and all the support that you provide us year in and year out. I thought the presentation was really good, informative, and obviously we're going to get you back in July to see what kind of progress we're making, and hopefully we'll have some good news to share at that point in time. So thank you, Mara,
Thank you very much.
for the insights.